Hi everybody, it's Rowan Smith from the Mortgage Center. I wanted to address penalties and interest rate differentials and 3-month interest penalties and how it all works today in this blog. I'm getting a lot of inquiries about it. There's some confusion as to why rates have gone up and penalties have gone down. Well, let's look at the standard mortgage terms. For variable rates mortgages at most institutions, the way that it's going to work is if you break the term at some point during any time. Now most variables are 5-year terms, but some of them are 3 years. So that means that during that period of time, your discount or your premium on your rate will not change. For example, if your rate was prime rate plus a quarter, for 5 years you would always be prime plus a quarter, regardless of where prime went, up or down, you would follow it with 0.25%. You're guaranteed that. So should banks go with prime plus a half or prime plus 1, you're still guaranteed to retain the prime plus a quarter throughout that 5-year term. In exchange for that security, if you break that term, that 5-year term, and sell your house or need to refinance to take equity out and end up doing it with a different lender, you're going to pay a 3-month interest penalty. So that's it's a non-negotiable. It's going to happen at every single institution. However, the 3-month interest penalty is the only one that will apply to a variable rate mortgage. In the event that you've got a fixed rate mortgage, it will be the greater of 3 months interest or the interest rate differential. Interest rate differential is kind of a complicated formula that essentially looks at how much time is left in your term, what rate you're paying now, what rate the bank could get on money now, and they charge you that difference. So that's a simplification, or perhaps an oversimplification of it. But if you visualize being at 6%, and let's say rates went down to the 3.69 they were at, and you wanted to get that rate, well, that bank would be giving up on 6% for the remainder of your 5-year term and letting you out into the lower term. So they're going to look at their lost profit and basically going to charge you that amount, or 3 months interest, whichever is greater. You can guarantee that in cases where rates have gone down, your penalty is going to be dramatically larger under the interest rate differential. Now, how far down? Depends. It's a complicated formula. How much time is left in your term? If you're within the last year, it's generally only ever 3 months interest. There's a lot of different variations on how these penalties can be calculated from bank to bank to bank. So, if you're looking at your penalty, not quite sure if the penalty is worth paying it to get the new lower rates, give me a call and I can walk through the math with you on it and make sure that you're making the correct decision. Also, if you're looking at that penalty and wondering, why did the penalty go down from last month when I had a quote? It's because rates came up. That means that the bank could get a greater rate for money loaned at the same point in time. So if you were 3 years into a 5-year term, there's 2 years left, the bank will compare their profit and loss with what they would get on a 2-year mortgage. So imagine, for example, that rates have gone in 2 years from, grab a number here, 2.25 to 2.9. Well, if you were previously paying 5%, that spread, the difference between what they could be getting and what they are getting, got smaller. Thus, your interest rate differential penalty will be smaller. So as you can see, there's quite a bit to penalty calculation. If you have any questions, give me a call for the Mortgage Center. I'm Rowan Smith.